everyone. The question I would like to address today is the risk binge credit markets are having since a couple of weeks. We don't know yet if having had the coronavirus makes us immune, but what we know is that central banks managed to immune markets to risk. The famous economist Adam Smith was talking about moral hazard, and moral hazard is something that can be applied to the current situation. It means that individuals are taking risk, behave in a way they would never if they had to be fully responsible for the risks they are taking. So to come back on the current situation, first quarter was difficult already. Growth in the US fell 4.8%. The economic outlook isn't good. And in parallel, companies are piling up cash like they haven't in like ever. At the end of April, it was almost 800 billion of new issues, of new bonds coming in the investment grade US dollar market. And this paper has no problem to be bought because investors are really participating to that party. The objective of central banks is to avoid as much as possible an economic crisis, and it's also to avoid liquidity distortion in the markets. It is not to address solvency problems for companies. It is not to rescue companies that are inefficient. But currently the market is very optimistic. It sees the glass that's half full and behaves in a way as if eventually everyone will be rescued. A good example of that change in mood is a company called Surgery Partner, who saw their bonds rebound from 60 to 95 in April. So why? Well, this is a company that is rated CCC-, so it's just one notch away from the D of default. So it's a very low grade company, and it has bonds maturing in more than four years. So it's not at all eligible to the plan of the Federal Reserve. But the change in the mood allowed the company beginning of April to find a loan, and this is this new liquidity that triggered the rebound in their bonds. But not everyone will find liquidity, and we will have to face some bankruptcies. So to see now credit spreads coming back to levels that are not that far away from the pre-corona outbreak is exaggerated. These premiums weren't taking into account risk of recession. They weren't taking account risk of bankruptcy or the drop in consumption. And also currently companies are piling up cash, not to invest or develop themselves, but just to compensate the drop in earnings. So we can wonder, is the investor really paid for the risk he's taking? Actually, this question should be raised in a more accurate way, which is more something like, does the investor deserve to be remunerated for a risk that is actually taken by the central banks? And another question is, how long is the open bar going to last? It's a question that is difficult to answer to, because fixed income markets are so manipulated that they have lost their predictive power. But currently what is sure is that it's better to drink this half full glass with the crowd rather than staying sober on your own. So what will make the difference in the end is, like for anything, is the quality. Be aware of the quality of what you consume, because this is the only thing that will soften the hangover. Thank you.